Let's discuss the question number 2 here. We have been given the trial balance as on 31/3/2015. Apart from that, adjustments. Adjustments are the transactions not identified just before the preparation of the trial balance and came to know only after the preparation of the trial balance. So, as we are aware about these things only after the preparation of the trial balance, we have to adjust these things in the trial balance. Okay, in the trial balance. Of course, we can pass journal entry for all as a normal journal entry. That journal entry will be named as adjustment entries here. Adjustment entries here. Is that okay? Now, adjustment number 1, and then what is the requirement here? Pass adjustment entries. Second, prepare adjusted trial balances. The adjusted trial balance is nothing but after passing the adjustment entries, we have to incorporate those things in the concerned account and then prepare a fresh trial balance. Prepare a fresh trial balance, which is the adjusted trial balance. Practically, we won't prepare the adjusted trial balance, not required at all. For the understanding purpose only, I am going to guide you how to prepare the adjusted trial balance. Adjusted trial balance is nothing but all the adjustments we are supposed to do while preparing the final accounts could have been already adjusted before the preparation of the final accounts. And prepare final accounts from the adjusted trial balance. From the adjusted trial balance, we have to prepare the final accounts. Is that okay? For the stock, what is journal entry? Come on. For the opening stock, that opening stock should be addable with the purchases and closing stock should be subtracted from the purchases to find out cost of sale. Cost of sale. Right. Otherwise, the material meant for sale will be identified. What is the expenses? Is it the purchases or amount of purchases used for sale will be the expenses. If you put that question rightly defined, only the amount of purchased item sold will be the expenses, not the purchases. So we have to adjust the opening stock as well as closing stock with the purchases to arrive the stock supposed to be considered as an expenses here. Right. So for opening stock, the journal entry will be opening stock will be added with the purchases. No, purchases by default debit balance, and if I want to add that, that will be addable with the purchases or debiting it. Okay. So purchases upon debit, purchases upon debit to opening stock, to opening stock. The value being 1000. The value being 1000 rupees. Is that okay? In case of closing stock, we have to subtract from the purchases, right? To subtract the purchases, that should be credited, and closing stock should be debited. So closing stock upon debit, two purchases, two purchases. This is how we can pass journal entry for opening stock and closing stock. The closing stock value being 3000 rupees. Then outstanding expenses, selling expenses. Right, what's the journal entry for that? In case of outstanding, the expenses should be debited to outstanding expenses will be posted here. Okay, selling expenses upon debit, selling expenses upon debit to outstanding selling expenses. Outstanding selling expenses. The value being 200. Okay. In case of advanced administration expenses, what you can do? In case of advance, should be subtracted from that expenses. So the expenses usually a debit balance to subtract should be credited here. Okay. So that advance should be now debited. Advance admin expenses should be debited. Okay. To admin expenses. To admin expenses. This value being 400. This value being 400. Clear? This value being 400. Commission receivable, also income. This is income accrued, otherwise outstanding. Income outstanding is an asset for you that should be debited to income. To income. The entry being accrued commission upon debit. If it is an asset, it will be a debit balance, right? Income receivable is an asset. It should be a debit balance. Keep that in your mind. Accrued commission. Account debit to commission account. To commission account. Especially this commission is an income, right? I'll just put that I in brackets representing that it's an income. 100 rupees. Rent received in advance. Income received in advance is a liability. Liability should be in the credit side. So the rent in advance should be in the credit side, and the rental account will be in the debit side, right? Rent account debit. Rent account. It's not expenses, it's income. To differentiate the income from the expenses, I put the I after the rent account. Rent account debit to rent received in advance. Rent received in advance. Okay. The value being 200 rupees. 200 rupees. And provide interest on drawings at the rate of 5%. How much is the drawing here? 1000 rupees. For that 5% will be created. We are not aware about the date of drawings. If the date of drawings is not given, preferably the interest on drawings will be calculated only for half year. So into 1 by 2 will be taken. Then the value being 25 rupees. And the interest on drawings just now we have calculated might have not been paid already. Right, so it's an outstanding. So interest on drawings is an expenses. Income, right? Interest on drawings and income should be credited here now. So interest on drawings account debit, interest on drawings account credit. Okay, and outstanding, still recoverable, okay. To interest on drawings, sorry. So the interest on drawings is an income, so I am crediting it. Interest on drawings. The value being 25, and it should be debited to which account? Outstanding interest on drawings. Outstanding interest on drawings is a representative personal account, right? Represents whom? That outstanding interest on drawings. Whom this one is representing? Owner. Owner. It represents the owner, right? Isn't it? Drawing should be adjustable with the capital only. No. The owner is always named as capital. Similarly, interest on drawings is payable to the owner only. The outstanding interest on drawings represents the owner. So I can, rather than put that value being the outstanding interest on drawings account, or directly I can debit the capital account. That way also you can post it. Is that okay? Capital account. Capital account is a direct account, right? Rather than you post that as the outstanding interest on drawings, you can debit the capital account here. The value being 25 rupees. I am charging that account. Actually, owner to whom the company is liable to pay 6,000 rupees for the capital. Because of the drawings, we have to deduct from 6,000. Not only that, he has to pay the interest on drawings also. That should also be subtracted. That's why the capital account is in the debit side now. And provide interest on capital at the rate of 6%. Provide interest on capital at the rate of 6%. Here, capital is how much? 6,000 rupees. For that, you have to calculate 6%, which is 360. So, see, you don't need to worry about the half year calculation here. Without the capital, the business will not run, right? So the capital will exist since the day one. Since the day one. Usually we calculate the interest on capital for the full year rather than half year. So we can calculate the interest on capital for the one full year rather than drawings. So in the case of drawings, we calculate only for the half year, but in the case of interest on capital, we calculate for one full year. The interest on capital is an expenses for us should be debited here. So interest on capital account debit. Interest on capital account debit, and to outstanding interest on capital. Outstanding interest on capital represents whom? The owner. Rather than I credit to outstanding interest on capital, I can credit directly to the capital account. So to capital. To capital. Okay. This value being 360. This value being 360. Now, 8th one is all about depreciate fixed assets at the rate of 5%. So, depreciation is the loss that should be debited and it will reduce the value of the assets. So, depreciation upon debit to fixed assets will be the correct entry here. Depreciation upon debit, depreciation upon debit to fixed assets, to fixed assets. I'll put that as F dot A. 5%. Here the fixed assets being 4,000 rupees. For that you have to calculate 5%. That 5% on that being 200 rupees. So we have completed all the 8 adjustments. Where in case of stock, always remember we can adjust the opening stock as well as closing stock simultaneously. Apart from that, verify if there is any investment or loan in the trial balance. If the investment and loan exist in the trial balance, verify whether there is any prefix by way of some number. That number represents the interest eligible for that. And date is also given. If everything is given, there is a hidden adjustment. Always cross verify if there is any hidden adjustment or not. So, for example, in this case, we are preparing the accounts for 31/3/2015. It means the account is also being for 1/4/2014 to 31st March 2015. Am I right? This investment originally purchased on which date? 1/1/2014. 1/1/2014. Before this year. This investment is with us for 1 full year. 1 full year. If the investment is with us for 1 full year, this one is eligible for 1 full year's interest. Then interest rate applicable for that is nothing but the prefix with an investment which is 12% for the 2000. Find out the 12% on that. So 2000 is 12%, 240 will be the interest on investment we supposed to receive. Verify if there is any interest on investment available in the credit side. And of course available, but how much is available? Only 100. From this it is very clear, as per our calculation, this investment is eligible for 1 full year's interest which is equal to 240. Currently, the interest on investment is only 100. So the difference between these two 140 maybe assumed to be the outstanding or accrued interest. Right. So that's similar to commission receivable. Income receivable only, no? So income receivable means you have to pass the same entry like fourth one. Right. Now the entry being interest on investment is an income recoverable, so it should be credited to interest on investment. Interest on investment. This is gain for us. 140. Actually, 240 should be there. 100 already received. 140 is pending. You have to cross verify this. This is called hidden adjustment. And in the debit side, we can name this also as being outstanding interest on investment. Okay, either you can name this as outstanding interest on investment, or you can simply debit to the investment account. Both the way you can post that. So 140. The same logic will be applicable for the loan also, but the loan borrowed only 1/1/2015. It means in the current year, almost the last quarter we purchased 1/1/15, last quarter. So from 1/1/15 to the year end, it was held as loan only for 3 months. So this loan will be eligible for only 3 months interest. So 4,000 rupees is the loan, right? So the loan amount is 4,000 and the rate of interest eligible for this loan being 10%, and the loan borrowed is only on 1/1/2015, or we enjoyed the loan only for the last quarter. So this will be eligible for only 3 months interest, right? So the 3 months interest being 100 rupees, am I right? Now verify, is there any interest on loan available in the debit side? No, we don't have any interest on loan in the debit side. So the entire 100 rupees will be now considered as outstanding interest on loan. So outstanding interest on loan is a liability, right? And interest on loan is the expenses that should be debited. So interest on loan upon debit. Interest on loan upon debit to outstanding interest on loan. To outstanding interest on loan. This value being 100. So we have almost posted everything. Always cross verify in case of investments and loan given in the trial balance together with the rate of interest being the prefix with the date of loan or investment. And you can calculate from the date of loan borrowed or until the date of repayment. You have to find out the rate of amount of interest, and it should be matching with the interest available in the P&L account with the trial balance. If it is not so, then maybe named as either advance or outstanding. In this case, we have found out the advance means outstanding interest on investment as well as outstanding interest on loan also we found out. We have now passed all this entry. These entries passed only after preparation of final accounts because we came to know these things were missed while preparing the trial balance. If we might have known already before the preparation of the trial balance, we might have comfortably passed the journal entry. But now we are adjusting those things. No, that's why it's called adjustment entry, right? Either maybe named as closing entry or adjustment entry. Now, the next one is all about prepare the adjusted trial balance. I am going to prepare the adjusted trial balance here. right? Now, so we have completed the past adjustment entries, prepared the adjusted trial balance. Incorporate all these things. Purchase debit, purchase credit. Already we have purchased 5,000 rupees in the debit. Because of opening stock, we debit once again another 1,000 rupees. Because of closing stock, we subtract 3,000 rupees. After these adjustments, the purchases value being only 3,000. Am I right? So the purchases of 5,000 rupees worth of stock, out of that, 3,000 only sold off. Means balance remains as an asset to be usable in the next period. That is not an expenses. Only the purchased items sold will be the expenses. Now we found out how much of purchased items sold in the current year. That can be found out by after adjusting the opening stock as well as closing stock from the purchases. And now we got it as 3,000 rupees, which is the adjusted purchases, also being expenses debited to the P&L. And opening stock in the credit side, already we have opening stock in the debit side. By doing this, the opening stock will disappear. And instead of that, we get a new stock, closing stock rupees 3,000 in the debit side. Rather than this 1,000 rupees, we now get 3,000 rupees. Rather than this being the opening stock, it's closing stock. It is closing stock. Am I right? Selling expenses should be inflated by 200 because of outstanding. Earlier, this is 1,000, now it is 1,200. Am I right? Then outstanding selling expenses, the liability, as such now, there is no such account. We have to open a new account and post that in the credit side as it is being the credit balance in the credit side. Right? So outstanding selling expenses. The outstanding selling expenses here being 200 rupees. Here being 200 rupees. Advanced admin expenses, we don't have such an account. Now I'm going to open that one in the debit side. Debit side. So advanced admin expenses. Advanced admin expenses. Okay. This value being 400 rupees. This value being 400. Then admin expenses 400 rupees in the credit side. Already we have admin expenses 1,000 rupees in the debit side. Because of this journal entry, it's a credit, it should be subtracted. After subtracting that, advanced means administration expenses hereafter only 600. Hereafter only 600. Accrued commission. So commission accrued. A new account now comes in the debit side. So accrued commission. Accrued commission. Okay. This value being 100. This value being 100. Commission income in the credit side. Already we have commission received 500 rupees. With that, another 100 rupees is supposed to be addable. After this, the commission becomes 600. Rental income debit. Rental income. Already we have 400 rupees in the credit side. Now the rental income is going to be debited because of the advance. It means it's going to be subtracted from the 400. Now it is going to be recorded as 200 only. Okay, 200. Is that okay? Now, rent in advance a new account. Now we have to post that in the which side? Credit side. Okay, rent in advance. Rent in advance. Accrued income, right? Accrued income. 200 rupees should be in the liability side or credit side. Capital should be adjusted. So the capital balance being 6,000. Now this capital 25 is the debit balance, so it should be subtracted, right? It should be subtracted. And here also we have another capital 360 the credit side. Credit segment it should be added. Now after doing these two adjustments with the capital, now the new capital balance being 3,335. Am I right? Verify this 3,335. Next, interest on drawings. A new account comes in the credit side. 6,000, right? Okay, 6,335. Okay. Capital is now 6,335. And interest on drawings in the credit side. I put the value in the credit side. Interest on drawings. This value be interest on drawings 25. 25. And then interest on capital. That should be the debit side, right? So interest on capital. This value being 360. And depreciation should be debited in the trading account, trial balance, sorry. Trial balance debit side 200. And that reduces the fixed assets value. Fixed assets by default debit balance. No. So now the fixed assets in the credit side, it should reduce the value. So it's not 4,000 anymore, it's only 3,800. Outstanding interest on investment. So outstanding interest on investment. Okay. This balance being 140 in the debit side. And interest on investment should be in the credit side. So interest on investment. Credit side of the trial balance, the value being 140. The value being 140. And interest on loan in the debit side. So interest on loan. Interest on loan. This balance being 100. As well as that becomes a liability to outstanding interest on loan. Interest on loan. This value being 100. After so much of adjustments, if you tally the trial balance, that will be the adjusted trial balance. That will be the adjusted trial balance. Come on, get me the value. 19,900. 19,900 is the total of the trial balance. So from this, it is very clear. If we are aware about these details much ahead before the preparation of the trial balance could have been this way. Okay. So we don't have such a trial balance because we were not aware about all these things at time of preparation. Now we adjusted that. We'll prepare the final accounts now. Trading and P&L account. Trading and P&L account. Trading and P&L account. And then balance sheet. And then balance sheet. Right. I'm going to post all these things. Debit side, purchases, where will it come? In trading account, debit side, so purchases, 2 purchases. This value being 3,000. You can join with me solving this illustration. Carriage in. It's an item of trading account should be deleted here, so carriage in. This value being 1,000. Admin expenses should be debited in the P&L account. Admin expenses. The value being 600. Selling expenses should be debited in the P&L account. So selling expenses. 1,200. Fixed asset should be posted in the balance sheet. Fixed assets FPA. 3,800. 12% investment, 2,000 rupees. Asset side, 12% investment. The value being 2,000. Apart from that, we have been given debtors, cash, closing stock. All the three are the assets only. If the closing stock appears in the trial balance, what does it mean? The adjustment entry for the opening stock and closing stock were already passed. After that, whatever the closing stock we have, which is nothing but simply an asset, should be transferable directly to the balance sheet. It will not appear in the trading account, right? Whatever the items available in the trial balance or any account form should be transferable only to one place. If it is in the adjustment, it should be posted twice. As the closing stock appears in the trial balance, it should be posted only once, that too in the balance sheet asset side, right? So stock in trade, this value being 3,000, and then drawing should be subtracted from the capital. So capital, from there I have to subtract the drawings minus drawings. The value of drawings here being 1,000. And advance admin expenses, where will it be posted? Advance admin expenses, real account or personal account or nominal account? Personal account. Will that come in the trading and P&L account? Trading and P&L account are nominal accounts, right? So that will contain only the nominal items, nominal account items, right? So advance admin expenses is a representative personal account, should go to the balance sheet only. So advance admin expenses, I am going to post that in the balance sheet asset side. Advance admin expenses. Okay, asset. This one is an asset for us, right? Advance admin. This value being 400. Accrued income, where will it go? Also representative personal account if it is being the debit side and it will be an asset only. So accrued commission, the value being accrued commission 100, and interest on capital, where will it come? Interest on capital is an expenses debit to the P&L account. It's the company's responsibility to pay the interest to the owner. Also an expenses. Depreciation, also an expenses, should be debited to the P&L account. The value being 200. Outstanding interest on investment, representative personal account will go to the balance sheet. As it's the debit side, it will go to the asset side. Outstanding interest on investment, otherwise accrued interest on investment. Accrued interest, value being 140. And what about the interest on loan? Interest on loan is a nominal account, expenses debit to P&L account. So here interest on loan. The value being 100. You have posted all the items given in the debit side to the concerned account. See, yeah, I missed what? Debtors, okay. Debtors and cash, I missed both. So debtors here being 2000 rupees and cash rupees 1000. I have posted all the debit values. The debit side of the trial balance items will be transferable to the debit side of the trading or P&L account or asset side. You should not have any more confusions. If you are posting the other way, other side, it should be a subtracting only. For example, drawings. Drawings should be the debit side. No, it should be posted only in the asset side. But instead of posting the value in the asset side, I am subtracting from the capital in the liability side. That is also accepted. Then credit side items. Sales, buy sales, the value being 7000, and capital 6335, 10% loan liability, 10% loan, the value being 4000, and then creditors 1000 liability side. Okay. Commission received, income, credit side, commission received, or simply commission 600, rent 200, and interest on investment, also income in the credit side of the P&L account 100. Outstanding sale expenses, come on, it's a representative personal account, will go to the liability side of the balance sheet. So outstanding selling expenses, the value being 200, and rent in advance, also liability. We have received our income in advance, we are liable now. Rent in advance, okay, the value being 200. Interest on drawings, income, right? So owner has taken the money, but then owner has to pay the money to the company. This is the income for the company. Interest on drawings, the value being 25, and interest on investment. Interest on investment here is 140. I can add up with this, right? So 240. It's a repetition. So I'll just do this addition there. So the value of interest on investment being 240. Stand corrected. Outstanding interest on loan is a liability. Will go to the liability side. So outstanding interest on loan. Either you can name this being outstanding interest on loan or simply loan 100 rupees. Now, if I type the trading account, the GP here being 3000 and I transfer the GP to the P&L account 3000 rupees. Of course, we could have passed the transfer entry also. Already we have seen the transfer entry details, so I don't go for that now. Right, you finish up tallying this to find out the net profit. What's the total of credit side? The total of credit side being 4065. 4065 here. 4065. What is the net profit then? 1605. 1605 should be addable with the capital. 1605. After addition of this, the capital being 6940. Finish up tallying the balance sheet now. The total of balance sheet being 12,440. 12,440. Is that okay? Come on, make a note of it.